Good day, everyone. So we are now on the last chapter, the chapter 17, which is on the internal control affecting liabilities and equity. Our learning objectives for this chapter is number 1, to describe the internal control over liabilities and equity accounts, namely accounts payable, other debts such as notes payable and bonds, equities such as share capital and dividends. Second is to understand the potential misstatements due to error or fraud of the liability and equity accounts and how weakness in internal control contributes to the risk of misstatements. I know that you are already familiar with accounts payable, but let's have a short review on it. Accounts payable is used to describe short-term obligations arising from a purchase of goods and services in the ordinary course of business. Other transactions creating accounts payable include acquisition on credit of merchandise, raw materials, plant assets, and supplies. We have also accounts payable if we perform services like legal and accounting service, advertising, and repairs and utilities. In thinking about internal control over accounts payable, it is important to recognize that the accounts payable of one company is the accounts receivable of other companies. It follows that there is a little danger of errors being overlooked permanently since clients' creditors will generally maintain complete records of their receivables and will inform the client if payment is not received. This way, it helps the auditors in the discovery of fraud. So now let's have some examples of misstatement and their internal control weakness. First, we have inaccurate recording of a purchase or disbursement. So the fraud example here is a bookkeeper prepares a check to himself and records as it as having been issued to a major supplier. The internal control weakness here is there's an inadequate segregation of duties of record keeping and preparing cash disbursements, or the check signer does not review and cancel supporting documents. So if you can still remember from the previous chapters, it is very important that there is a segregation of duties, especially when purchasing assets, because it prohibits only one person to work for the acquisition, their custody, and the record keeping of the asset. For example, one person can place an order to buy an asset, but there should be a different person that should be recording the transaction in the accounting records. By separating duties, it is much difficult to commit fraud because there is at least two persons who will be working together. Unlike for only one, it is easy to commit fraud if there is only one to acquire the asset and records in the accounting transaction. Next is an error example. Here is a disbursement is made to pay an invoice for goods that have not been received. So the internal control weakness here is there's an ineffective control for matching invoices with receiving documents before disbursement are authorized. Next is description is misappropriation of purchases. So there's a fraud here. Goods are ordered but delivered to an inappropriate address and stolen. So the internal control weakness is there's an ineffective control for matching invoices with receiving documents before disbursement are authorized. Next is duplicate recording of purchases. An error example is when a purchase is recorded when an invoice is received from a vendor and recorded again when a duplicate invoice is sent by the vendor. So from the word duplicate, so there is an ineffective control for a review and cancellation of supporting documents by the check signer. So, check signers are individuals authorized for um, checking the checks or authorized to sign checks for businesses, companies, and corporations. They are also responsible for ensuring that checks for signature are legitimate and prepared according to the organization's accounting procedures. Next is there's a late or early recording of purchase. The fraud is purchase journal closely early with this period's purchases as having occurred in a subsequent period. So the internal control weakness here is ineffective board of directors and audit committee. So if you can still remember, the role of board of directors audit committee is to review and approve the external and internal audit function. As you can see also, there's internal control on undue pressure to meet earnings target. So when we say undue pressure, this is attitude of the management that pressure the employee, which is they are recording, just like our example, they are recording the subsequent period acquisitions as current year acquisitions only to meet the target, which is inappropriate and can cause misstatements in preparing our financial statement. Now, let's go to the financing cycle activities. It refers to the acquisition and repayment of capital. This includes procedures for authorizing, executing, and recording transactions that involve bank loans, mortgages, bonds payable, and other capital stock, as well as payment of interest and dividends. So in other words, financing cycle activities are transactions and events whereby cash is obtained from or repaid to the creditors or owners. So now let's have the internal control over debts. So an effective internal control starts with the authorization by the board of directors. So in the bylaw of a corporation or a company, it is clearly stated that the board of directors are those required to approve borrowings. Treasurer also prepares report on any proposed financing, explaining why there is a need for funds, its effect in the financial position of borrowing upon future earnings, and compares it with others both before and after borrowing and alternative methods of raising funds. Authorization also include the choice of bank or trustee, the type of security, registration with Securities and Exchange Commission, agreements with investment banker, listing of bonds on security exchange, and compliance with requirements of state of incorporation. Board of Directors shall also furnish a copy of report stating the net amount of received and its disposition. Next is the use of independent trustee. Trustees does not have access to the issuance of company assets or accounting records, but they are paid by the company as independent party who is in charge with the protection of creditors' interests and monitoring the company's compliance with the provision of indenture. The last one is the interest payments on bonds and notes payable. Many corporations assign the entire task of paying interest to the trustee for either bearer bonds or registered bonds. Highly effective control is achieved since company will issue a single check for the full amount of the semi-annual interest payment on the entire bond issue. So that's conclude the internal control over liabilities. Let's now proceed with Jericho, the internal control over equity.
Internal control over owner's equity. There are three principal elements of strong internal control over share capital and dividends. First, the proper authorization of transaction by the board of directors and corporate office. Second, the segregation of duties in handling this transaction, preferably the use payments. And third, the maintenance of adequate records. And now, internal control on equity. Control of share capital transaction by the board of directors. all changes in share capital accounts should receive formal advance approval by the Board of Directors. The Board of Directors must determine the number of shares to be issued and the price per share. And if an installment plan of payment is to be used, the board must prescribe the terms. If plant and equipment, services, or any consideration other than cash is to be accepted in payment for shares, the board of directors must establish the valuation on the non-cash asset received. Transfers from retained earnings to the share capital and paid-in capital accounts, as in the case of stock dividends, are initiated by action of the board. In addition, stock splits and changes in par stated value of shares require formal authorization by the board. Authority for all dividend action rests with the directors. The declaration of a dividend must specify not only the amount per share, but also the date of record and the date of payment. Independent registrar and stock transfer agent. In appraising internal control over share capital, the first question that the auditors consider is whether the corporation employs the services of an independent share registrar and share transfer agent, or handles its own capital share transactions. Internal control is far stronger when the services of an independent share registrar and stock transfer agent are utilized, because the banks or trust companies acting in these capacities will have the experience, the specialized facilities, and the trained personnel to perform the work in an expert manner. Moreover, by placing the responsibility for handling share capital certificates in separate and independent organizations, the corporation achieves to the fullest extent the internal control concept of separation of duties. Internal control over dividends. The nature of internal control over payment of dividends, as in the case of stock issuance, depends primarily upon whether the company performs the function of dividend payment itself or utilizes the services of an independent dividend paying agent. If an independent dividend paying agent is used, the corporation will provide the agent with certified copy of the dividend declaration and a check for the full amount of the dividend. The bank or trust company serving as a stock transfer is usually appointed to distribute the dividend. Since it maintains the detailed records of shareholders, the agent issues dividend checks to the individual shareholders and sends the corporation a list of the payments made. The use of an independent fiscal agent is to be recommended from the standpoint of internal control, for it materially reduces the possibility of fraud or error arising in connection with the distribution of dividends. In a small corporation that does not use the services of a dividend-paying agent, the responsibility for payment of dividend is usually lodged with the treasurer and the secretary. After declaration of a dividend by the board of directors, the secretary prepares a list of shareholders as of the date of record, the number of shares held by each, and the amount of the dividend each is to receive. The total of these individual amounts is proved by multiplying the dividend per share by the total number of outstanding shares. Dividend checks controlled by serial number are drawn payable to individual stockholders in the amount shown on the list described above. If the shareholder's ledger is maintained on a computer master file, the dividend checks may be prepared by the computer directly from this record. The stockholder list and the dividend checks are submitted to the treasurer for approval and signature. The checks should be reconciled by the treasurer with the total of shares outstanding and mailed without again coming under control of the officer who prepared them. Cash in the amount of the total dividend is then transferred from general bank account to a separate dividend bank account. As the individual dividend checks are paid from this account and returned by the bank, these should be matched with the check stubs or mark paid in the dividend check register. A list of outstanding checks be prepared monthly from the open stubs or open items in the checks register. This list should agree in total with the balance remaining in the dividend bank account. Companies with numerous shareholders prepare dividend checks in machine-readable form so that the computer may perform the reconciliation of outstanding checks.